You are listening to The Vocal Technologist. Spoken tech for your ears.
AI is completely reshaping finance. But finance teams are spending 13 hours a week just double-checking its math. Both are true.
Yeah, the productivity gains are essentially just being zeroed out by compliance paranoia. We have built these hyper-sophisticated systems to do the heavy lifting, yet we still need a human standing over their shoulder to make sure they haven't, entirely lost the plot.
Welcome to Vocal Technologist, where we just sit down and try to nut out what is actually happening in tech.
Yeah.
I am really keen to get into this for Founder Fridays because the bit rattling around my head is this massive identity crisis playing out across financial tech right now. Like, every app on your phone is mutating, nobody is sticking to their original lane, and the plumbing keeping it all together is just under immense strain.
It is totally a survival mechanism. The traditional boundaries between, say, a bank, a payment gateway, and a social platform, they are just eroding, completely eroding.
Yeah, so let's start with the surface layer, right? What you and I actually see when we open our phones. Every single financial app is suddenly trying to run your entire life. Look at Klarna.
Right, the buy now, pay later guys.
Exactly. You know them for the pink UI and the ubiquitous checkout button, but now they are applying for an FDIC-insured bank charter out in Utah, which is wild.
Well, it fundamentally changes what they are as a business.
Right. But why does a buy now, pay later checkout button need to become a literal bank? Are they having a lend?
I wouldn't really look at it as a choice, honestly. I look at it as an economic necessity. Like, when interest rates were sitting at zero, borrowing money to lend to shoppers for 6 weeks was incredibly cheap.
Basically free money.
Exactly. They could afford to just be a button. Now that the zero interest rate era is over, the unit economics of a standalone buy now, pay later service just bleed money. The cost of capital is way too high.
So they need our actual cash.
Spot on. They need retail deposits. If they get a bank charter, they bring all that infrastructure in-house. They can use your deposits to fund the loans they make at checkout.
Ah, I see.
Yeah, it dramatically lowers their funding costs, and it means they don't have to rely on partner banks who obviously take a massive cut of the transaction. They want to own the entire life cycle of your money.
And then you have Visa doing something similar, because they are launching a mobile-first travel platform called Visa Destinations. They want to be your, quote, travel companion, offering curated city guides and tastemaker recommendations.
Right, getting into the lifestyle space.
It just feels like walking into a hardware store for a hammer and they insist on giving you a haircut. Like, why is my piece of plastic trying to curate my holiday?
That hardware store analogy is heaps of fun, but it is sort of looking at it backwards. Visa, acting as a travel agent, isn't a hardware store giving you a haircut. It is the company that paved the highway, deciding they also want to own all the rest stops and billboards along the route.
Okay, wait, lay that out for me.
Well, the physical swipe of a credit card is becoming a commodity, right?
Yeah.
Digital wallets, instant account-to-account transfers, biometric payments, all of these bypass the traditional plastic card entirely.
Yeah, I haven't carried a physical wallet in ages.
Exactly. And Visa knows this, so rather than just waiting at the checkout counter to collect a toll, they want to capture your intent before you even decide to buy.
So if they curate your holiday.
They keep you inside their ecosystem, from the moment you book the flight to the moment you pay for dinner in Rome.
So they are moving up the funnel.
They absolutely have to. The margins on basic transactions are getting squeezed everywhere by digital-first challenger banks. To survive, you need durable, multi-product relationships where you are just indispensable to the consumer's daily life.
Which brings a company like Robinhood into focus, because they are moving light years beyond being just a simple app for trading meme stocks on your lunch break.
Oh yeah, they are building heaps of new infrastructure.
Yeah, they have launched a Layer 2 blockchain for real-world assets. They are offering a 7% yield product, and they are rolling out global stock tokens so people in over 120 countries can trade.
Robinhood is quietly trying to become a decentralized prime broker.
I see this term thrown around constantly, but what does that functionally mean? What does a prime broker actually do?
So a traditional prime broker is usually a massive Wall Street bank that sits behind a hedge fund. They provide the plumbing.
Right, the behind-the-scenes stuff.
Exactly. They lend them cash, clear their trades, hold their assets, and handle the collateral. Robinhood wants to provide that exact same institutional-grade plumbing, but they want to offer it directly to retail users globally.
And the Layer 2 blockchain part, how does that change the actual mechanics of it?
Normally, when you buy a A centralized clearinghouse takes, a couple of days to actually settle that trade.
Oh, the T+2 delay thing.
Yeah.
Hmm.
That delay requires massive capital buffers, which famously caused Robinhood a lot of grief a few years ago. But the Layer 2 blockchain handles transactions off the main congested network and settles them instantly with cryptographic proof. By building this out, Robinhood is essentially rebuilding the structural pieces of the U.S. market, just bypassing the traditional clearinghouses entirely and stuffing it all inside one vertically integrated platform.
Well, you cannot bypass the settlement layer without talking about the actual physical cables moving the money. If every company wants to offer every service, they have to control the hidden infrastructure underneath.
The stuff the average consumer never sees.
Right. There are some very quiet boardroom deals happening right now. Case in point is Fiserv. They are reportedly in talks to sell their Star network, which is this massive debit payments infrastructure, to the absolute mega banks. We are talking JP Morgan, Bank of America, Wells Fargo.
Yeah, the Star network routes billions of transactions. It is a highly critical piece of plumbing.
I have to admit, this feels a bit dodgy to me. So rather than fighting over the toll booth, these mega banks are just trying to buy the entire highway. I read this is a play to bypass federal fee caps. But how does physically buying a network actually change the fee structure?
It comes down to routing choices. Under U.S. regulations, specifically things like the Durbin Amendment merchants, are supposed to have a choice of at least 2 unaffiliated networks to route a debit transaction.
Okay, to create competition, right? To keep the fees down.
Exactly. This creates competition. And the banks absolutely hate this because it eats into their revenue.
I see where this is going.
If the mega banks buy the Star network, they suddenly own one of the major alternative routes. They control the rules of the road. Lawmakers and merchants are terrified because if the banks own the underlying rails, the merchants lose any leverage they had to negotiate.
Make this real for the listener. If I am just tapping my card for a $5 coffee, what does this deal mean for my local cafe?
It means your local cafe might entirely lose the ability to choose a cheaper, independent routing option for that transaction. The banks dictate the terms, the processing fee goes up, and suddenly that $5 coffee gets a lot more expensive for the cafe to process.
And eventually that cost gets passed on to you.
Yeah, it basically becomes a monopoly on the movement of money, a defensive play.
It is wild how much of this happens completely out of sight. I also read that payment success rates are shifting, like from being this boring IT metric that sits in a basement dashboard to a critical boardroom metric.
Oh, absolutely. A failed payment used to just be seen as a technical glitch. A server timed out, retry the card, no big deal.
But today,
Digital commerce is engineered to be entirely frictionless. If a payment fails now, it isn't a glitch, it is instant lost revenue.
and a massive hit to customer trust. Because if I am checking out and the payment declines, I do not blame the underlying routing network. I blame the retailer or I blame my bank, and I probably just abandoned the cart entirely.
Right. Friction is the enemy of conversion. You do all this expensive marketing to get someone to click buy, and if the final millimeter of the pipe breaks, you lose the sale.
Which is why companies like Plaid are having preliminary talks for an IPO, I imagine.
Exactly. Plaid is the connective tissue between your bank account and these apps. They are leaning heavily into new AI risk models to ensure those connections are secure and the money actually moves instantly.
AI is just being woven into all this plumbing now. I saw that OpenUSD is positioning itself as shared infrastructure, backed by 140 companies.
It is a massive coalition.
But what caught my eye is they are not trying to beat retail stablecoins like Tether or USDC. They're going after institutional cross-border settlement.
Because institutions fundamentally do not want to rely on a single private company issuing a retail stablecoin. Big banks hate the fees of traditional cross-border transfers, and they really hate the risk of unregulated crypto.
So what does OpenUSD actually solve for them?
Velocity and neutrality. OpenUSD is trying to create an interoperable standard. They want to make digital dollars usable for capital markets cash settlement.
Right, moving big money.
Exactly. It is about the speed at which $1 million can move between institutions in Tokyo and New York without getting stuck in a correspondent bank for 3 days over a long weekend.
That velocity argument is fascinating. And hey, if you are keen on keeping up with this sort of madness, just hit subscribe wherever you're listening. It genuinely helps us out. But getting back to it, this velocity thing leads to a massive contradiction. You cannot lay down all these high-speed automated AI pipes without running into the ultimate bottleneck, which is trust.
Yes, the AI paradox.
Exactly. Let's look at the human cost first. The tech and finance sectors are shedding an average of 28,000 jobs a month right now, heavily impacting customer service and administrative roles, claims processing, bank tellers.
The routine, repetitive cognitive work is just being handed over to algorithms.
But here is the stat that completely threw me. A new report shows that finance teams are spending an average of 13 hours a week just verifying AI-generated outputs. 13 hours.
It is a huge drain on resources.
Imagine being a CFO, right? Paying a six-figure salary to a financial analyst, only to realize their entire Tuesday and half of Wednesday is spent doing long division to make sure ChatGPT didn't hallucinate a decimal point.
The verification tax. It is a brilliant term for it.
Are they having a lend? We are sacking the tellers to hire babysitters. What is the point of the automation if the compliance checking takes a day and a half?
Well, because the stakes in finance are existential. If an AI writes a marketing email and gets a word wrong, it is embarrassing. If an AI hallucinates a number on a compliance report, someone literally goes to jail.
Right. Okay, fair point.
So finance leaders are demanding what they call glass box AI.
As opposed to a black box.
Correct. A black box makes a decision, and when you ask it why, it basically says, well, because my neural net weights align this way. That does not fly with regulators.
No. Definitely not. So a glass box is completely transparent.
Yes, a glass box provides a human-readable audit trail. It shows you the exact documents it referenced, the rules it applied, and the logical steps it took to reach that number. Without that audit trail, the AI is a liability, not an asset.
Which perfectly explains what is happening with Norm AI right now.
No.
They just hit a $1.2 billion valuation.
Yeah, massive ramp.
But they did not do it by just selling compliance software to lawyers. They literally launched their own law firm, Norm Law.
It is a phenomenal disruption of a legacy business model.
They charge by the outcome, not the hour. I want to spend a minute on this because how does a law firm even function without the billable hour?
The billable hour fundamentally rewards inefficiency. Think about it. If it takes a junior lawyer 10 hours to review a stack of contracts, the firm happily bills for 10 hours.
Sure.
But if you deploy an AI agent that can review those same contracts flawlessly in 4 seconds, you cannot exactly bill the client for 4 seconds of work. Your revenue would drop to zero.
So you have to change what you are selling.
You sell the completed task. Norm Law uses their AI to deliver the service directly, bypassing the billable hours industrial complex entirely. They charge a flat fee for the outcome, a finalized compliance review, a drafted contract.
And everyone wins, I guess.
Pretty much. The client gets cost predictability, and the firm operates with software-like profit margins because the AI is doing the heavy lifting.
And that contrasts so sharply with what we see on the consumer side. In the back office, we are terrified of the AI making a mistake. But on the front end, consumer tools are thriving. AI is being let off the leash to actually do things. Agentic commerce.
We're entirely comfortable with AI operating in low-stakes environments where friction is the enemy.
Look at Square. They are integrating Claude and ChatGPT so AI can handle food ordering. You just chat with the AI on your phone, and it syncs directly with the restaurant's point-of-sale system, the kitchen, the inventory.
Oh, and Alipay in Asia is upgrading millions of their offline tap devices into an AI agent-powered network. It is not just tapping to pay anymore. The AI is negotiating the transaction.
We fully trust AI to sell us a burger, but we fundamentally do not trust it to do the books.
Because in consumer retail, a mistake means you get the wrong side order of fries. The restaurant comps it and everyone moves on. In the back office, friction is a feature, not a bug.
You actually want things to slow down.
Exactly. Friction is compliance. You want things to slow down when real money is moving between ledgers.
So we have all this capital and all this AI compute sloshing around the system right now. It is finding some very strange, very fast outlets. And the biggest wild card seems to be prediction markets. Everything is turning into a giant, high-speed prediction engine.
The numbers are staggering, truly.
Driven largely by the World Cup, I imagine. Polymarket hit $10.8 billion internationally. Kalshi crossed $31 billion in volume.
And $31 billion is not just people having a casual punt with their mates at the pub. That is institutional scale capital moving based on real-world events.
It is a massive stress test for regulators trying to suss out market integrity. And what really caught my eye is that Meta actually considered buying Kalshi.
Which tells you everything about the underlying value of attention right now.
How so?
A prediction market forces a user to put their money where their mouth is. It creates instant, incredibly sticky engagement. You don't just mindlessly scroll past a post. You are financially invested in the outcome.
But Meta ended up pivoting. They backed away from Kalshi and started building their own play money prediction app called Arena. Why walk away from the real money?
Algorithmic liability. Meta is already fighting battles on multiple fronts. TikTok just settled a massive lawsuit from a 15-year-old over teen addiction.
Yeah, I saw that.
They're facing thousands of related cases. Meta and Snapchat have their own trials coming up regarding how these engineered systems impact youth.
It is a massive financial risk.
It is. Meta absolutely does not want to add real money gambling regulations on top of their existing algorithmic liabilities. The legal pressure is too intense. Play money gives them the engagement mechanics without the regulatory nightmare of running an unlicensed casino.
But Meta still needs to monetize all this AI infrastructure they have built. And this is where they are pulling a move straight out of the space industry. They are looking at selling off their excess compute capacity to enterprise customers.
Treating their massive data centers as a revenue asset.
It feels exactly like the SpaceX model.
It is the exact same playbook. SpaceX built their own rockets because they needed to launch the Starlink satellite network. Once they had the best, most reusable rockets in the world, they realized they could just charge other companies to put cargo on them.
Right. And Meta spent billions building massive GPU server farms to train their Llama AI models.
Exactly. Now that the infrastructure is built, they have excess compute capacity. Why not rent it out to other enterprises?
So Meta is sitting on so many GPUs, they are renting them out to enterprise clients, like a digital Airbnb. Meanwhile, people are trading $31 billion on football matches. It feels like the internet has just turned into a massive casino powered by supercomputers.
I mean, it can certainly look a bit ordinary from the outside, but the real winners in the next decade of tech and finance might not be the consumer apps taking all the regulatory heat.
Right.
It won't be the flashy prediction markets or the social media platforms defending their algorithms in court.
The winners are the ones selling the shovels.
The infrastructure providers. The companies quietly selling the compute. The ones laying the pipes. Owning the data centers and the GPU capacity is proving to be just as valuable as building the AI models themselves.
It is incredible how the lines in fintech are just completely gone. You have a checkout button trying to be a bank, a credit card network trying to be a travel agent, and a social media giant acting like a cloud server provider.
The plumbing is being entirely rewired while the water is still running.
We've spent decades building tools to make money move faster and smoother. But as we hand the steering wheel over to these AI agents, the final bottleneck isn't going to be the technology. It will be whether we can actually stomach the consequences of trusting it. If this got you thinking, pop over to our YouTube and leave a comment. Until then, you can find our notes over at vocaltechnologist.cyu. Vocal Technologist, see you soon.
Spoken Tech for your ears.